Welcome to our BRI Investor Survey evaluation. In this third episode, we want to take a more precise look at various types of investors like insurance companies or pension schemes. If you have missed out our past two episodes, I strongly recommend you to have a look at these. There, we talked about ESG, why European institutional investors follow an ESG strategy or why not. And we talked about the current asset allocation and the SAA of those institutional investors. Now, let's take a closer look at three of those investor types. Who are they and what differs them from the average investor? So, let's go inside. At first, we start with the Insurance Spotlight. We can see that the asset allocation differs partly between the average investor and insurer. We can see this most clearly in the examples of real estate debt and infrastructure debt, where the percentage of insurance companies allocating is significantly higher in comparison to the average German investor. And in the example of hedge funds, here it's the opposite. The percentage of insurance companies allocating is only half as high as the average German institutional investor. We can observe the behavior of insurers even better in this next graph. It is now even more obvious that commodities, hedge funds, liquid alternatives or cryptocurrencies do not play any or only a minor role in the portfolio of an insurance company. The focus seems to be more at the illiquid private market, such as corporate private equity and debt, infrastructure equity and real estate debt and equity. Lastly, we want to take a look into the future of asset allocation of insurance companies. This little graph, we can see the intended changes in allocation for the insurer. It is clear that for most insurance companies, the intention is either to maintain status quo or to even increase the allocation of alternative investments. Next, we have the so-called German Versorgungswerke, we refer to as pension schemes. So, what differs pension schemes from the average investor? As you can see, there are three asset classes which stand out: corporate private debt and equity, as well as real estate debt. Here, pension schemes seem to be significantly more invested than the average investor. In the next graph, we can see a rather similar picture of asset allocation like before with the insurance companies. Clear focus at corporate private equity and debt, infrastructure equity, as well as real estate equity and debt. Is there any intended change in allocation for pension schemes? Well, in terms of maintaining the status quo, we can see a similar picture compared to insurance companies. But it is obvious that there is nearly no intention in decreasing any alternative allocation, with some exceptions for real estate and other tangible assets. In contrast, we can see a huge intention in increasing the allocation in terms of corporate private equity and debt, as well as infrastructure equity and debt investments. Last but not least, we take a look at corporate investors, pension plans and funds. Their asset allocation represents the average investor quite well. Nevertheless, we can see a significant lower percentage of pension plans, funds, CTAs and corporate investors allocating to real estate debt. The main focus seems to be on investments in corporates, equity and debt, as well as in infrastructure equity and in real estate equity. Lastly, we want to take a closer look at the planned changes in allocation. In the overall view, we can see only very little intention in decreasing the allocation of any asset class. Real estate is an exception here as well. The overall picture, there is a rather mixed among investors. The same applies to infrastructure debt. Equity investments in infrastructure, on the other hand, are to be expanded. The same applies to investments in private equity, private debt and other credit specialties. In summary, it can be stated that all investor groups want to increase their allocation in alternative investments. Nevertheless, it must be questioned whether this is at all feasible for everyone at the current state of the market. The traditional liquid markets, stocks and bonds, have come under pressure in 2022, and those also the portfolios of investors. Among other things, dominator effects have a significant impact and are currently preventing the expansion of the alternative portfolios. The data for this video comes from our annual investor survey. You can read The whole survey in the link in the video description.